All right, super morning, everyone, and welcome to the Freedom Investors webinar. Super awesome to have you here. Great to see that you want to learn because those who learn are the ones who earn. So, super awesome that you're here to learn. And let me just make sure that you're able to see me and hear me. So, if you're able to see me and hear me, just type in hi in the comment box. If you're able to see me and hear me, just type in hi in the comment box. It's great, to have you here. Good to see that you want to learn because there is this saying in the market that if you come here with money, if you come to the stock market with money, you give the money to the stock market and you get back a lesson and experience. And next time when you come back with money and that little bit of experience, you give more money to the stock market, get more experience. And once you have enough experience and then you come back with money and experience, it is then that you start making money. So, in order to make money here, you need to have experience and you need not lose money in the stock market in order to gain that experience. You can learn from someone else's experience as well. You don't have to waste your money here, lose money in order to gain that experience. You can learn from someone else's experience, and that's what you're doing. You are here to learn from someone else's experience, and that's a smart way to learn. That is a smart way to learn, right? So just type in I am smart in the comment box. Type in I am smart because you are here to learn. Not many people bother to learn, but you are here. So just type in I am smart, and whenever you're talking about yourself, just make sure that you say the positive things only. Never talk negatively about yourself. Always say the positive things only. Okay. So yeah, type in I am smart and you're here to learn. Super awesome. Let's get started. And I'll be sharing my screen and I'll be making some changes to the chat settings so that all of you can concentrate here. Okay. So that all of you can concentrate here. I'm going to make some changes to the chat settings. And yes, yeah, super. Right. Awesome. So I'm going to share my screen here. Yeah. Yeah. Super. I'm going to share my screen. And this is what we would be learning today. Okay. We would be learning how do you go about building a super profitable stock portfolio. Okay. That's something that we'll be learning. And there are three secrets that we would be learning. Okay. And I'm going to share my Excel as well here. Right. And this is what we'll be learning. We'll be learning three secrets that will help us build a super profitable stock portfolio. Okay. So the secret number one that we would be learning today would be when to buy. What is a good time to buy? Because you just can't be buying at any point of time. We need to buy at a good time. What is that time? When the price is low. We gotta buy low, as they say, right? Buy low. But you also need to understand when would the price be low. The price would be low when majority is selling, and majority would be selling if times are not good. If there's some problem going on, people are selling, there is panic, then people would be selling and they'll be selling fast. They want to get rid of what they have. So the price would be low, but there's a reason why the price is low. There's some problem going on in the economy or in the country. There's some war, can be any reason, right? So the time is not good, price would be low, but how do you decide that now is a good time to buy? Is something that we'll be learning in the secret number one. Secret number two would be about what to buy, right? What is it that we need to buy? There are 5,000 plus stocks in National Stock Exchange. There are more than 7,000 stocks in Bombay Stock Exchange. How do you decide which stocks to buy? Where to go and select the good stocks? You just can't be just buying any stocks, right? If you buy at the right time, but buy the wrong companies, you would still be losing money here, right? So here we'll be talking about the names of the stocks that you can buy, all that you'll be learning here, okay, in the secret number two. Then in secret number three, we would be learning about the strategy that one needs to have in order to make money, okay? We need to learn about a strategy that really, that can help you, because if you do not have any strategy, and most of the people in stock market do not have any strategy at all, right? They don't have any strategy, and they're the crowd, and we don't want to follow the crowd. Now, who's the crowd? What is crowd? Crowd is majority of the people who never make money in the stock market. They lose money. And we don't want to follow what the crowd does. And what they do is they invest a small little amount every month, right? You must have heard about SIP, systematic investment plan. So every month they keep investing a small little amount and they hope that something good will happen in the future and they would be able to, save a big amount, right? The only problem with this is that this will take, it will take a long, long time for them to achieve anything, right? Long time, because what they're doing is, and majority of the people are doing this, small little investment every month, and they're hoping something big will happen in the future, but this is gonna take a long time, right? And there's something that we don't want to do, because whatever the crowd does, you can't live, extraordinary life with it. You'll get average. If you do what the crowd is doing, you'll just get the average. If you follow the crowd in the stock market, you lose money, right? Now, how many of you want average? How many of you are looking to live an average life? You want to, have an average bank balance, average car, average vacation. How many of you want an average life? Just type not me in the comment box. Yeah. Just type in not me in the comment box, because we don't want an average life. Now, in order to not have an average life, in order to have better than average, you need to stop following most of the people, the crowd. So if you follow the crowd in the stock market, you'll never be able to make money. So what kind of a strategy you need to have is something that we'll be learning in the secret number 3. Okay. And this will help us build this super profitable stock portfolio. Okay. Now, this whole workshop is going to be 2 hours long. Okay. And we will be together from 11 to 1. Okay. It can be 1:15 as well. Okay. We'll be together from 11 a.m. to 1:15 p.m. Okay. And this is what we'll be learning. Okay. And this is a live workshop. It's not one of those recorded workshops. How many of you can see the date and time on the right hand side? Yeah. Can you, on the top right, can you see the date and time on the top right? It is Sunday today and 28th of August. Just type in live in the comment box if you're able to see it. Okay. If you're able to see it, just type live in the comment box, because it is a live workshop. Today is Sunday, 28th of August. The time right now is 11:08 and we are learning live. Okay. Yeah. It's not one of those recorded workshops. Okay. It's a live one. And these are the 3 secrets that we'll be learning today. And before we jump into the 3 secrets, I want you to understand about the stock market a little bit. So we'll understand about the 3 secrets, but let's just learn about a little bit about the stock market and how it works. So there are a couple of points that I want to, cover, and then we'll go and learn about the 3 secrets. So a couple of points. The point number 1 is that the power of compounding, and the way you can compound your money here in the stock market, there is no other asset class that can really compound the money with the way the stock market can, right? If you talk about, the returns here, so mostly you would see Indians are interested in investing in fixed deposit or PPF. That's where they want to invest mostly. They feel comfortable. Now, what kind of returns can you get from, let's say, fixed deposit? What kind of returns can you get on an annual basis? Give me a rough idea. What kind of return can you get? Yeah, about 6%. Yes. Now, when you're talking about return, 6%, 8%, 10%, 20%, whenever you're talking about the returns, investment is a game of doubles. Getting that return is a game of doubles. You got to ask yourself, how much time will it take me to double the money if I'm getting this much return? It can be any 15%, 20%, 5%, 10%. How do you calculate this, right? So there is something called rule of 72, right? Now, what is rule of 72? Now, rule of 72 says that if you want to find out how much time will take you to double your money, simply divide 72 by the rate of returns. Okay. So here in this case is 6. You will find out how much time will take you to double your money. 72 divided by the rate of return. So here it'll take you 12 years. Now, do you think if you're doubling your money every 12 years, can you be rich or wealthy? Yes or no? Can you be rich or wealthy if you're growing your money by 6% and doubling it every 12 years? No, of course not, because we are barely beating the inflation here. And the inflation that really matters, the food inflation, education inflation, healthcare, inflation is a lot higher than 6%. So you're not even beating the inflation here. So you can't be rich if you're investing in fixed deposit or PPF. It won't help you, amass a fortune, right? So now let's talk about the stock market. Let's talk about the stock market. Now, stock market has typically, put it here, stock market has typically given, close to, okay, it's okay. Okay. So the stock market has typically given, 16% kind of return. Is that okay? Yeah. Yeah. 16%. Can I say this? That the stock market has typically given around 16% kind of returns. Yeah. 16%. 15, 16%. Yes or no? Yeah. The stock market has given 15, 16% kind of returns, right? Historically, if you take into account dividend of 1.5%, it has given more than 16% return as well. But even if you don't take dividend into account, it has given 15, 16% kind of returns. Now, that's pretty good, right? Now, if you're gaining around 15, 16% on an annual basis, how much time will it take you to double your money? Again, we'll be using rule of 72. Now, rule of 72 is you divide 72 by the rate of return. So 16, they'll give you 4 to 5 years. So in about 4 to 5 years, you'll be able to double your money. If you're growing your money by 15, 16%, in about 4 to 5 years, you'll be able to double your money. And that's pretty good, right? If you're able to double your money in about 4 to 5 years, that's pretty good. But what do I mean here? When I say, if you invest in stock market, it has given this much return in the past, what do I mean? What has given this much return? Where in stock market do you invest? So here, what I mean is, I mean index investing. This is what I mean. Index investing. Index would be like, Nifty or Sensex, right? How many of you have no idea what Nifty or Sensex is? Just type DNK in the comment box. DNK is do not know. If you do not know about Nifty or Sensex, just type DNK in the comment box. DNK is do not know. So if you do not know it, absolutely okay. I'll tell you what Nifty and Sensex is, right? They are the index, right? So Nifty is a combination of the top 50 companies. Sensex is a combination of the top 30 companies. So Nifty is the flagship index of National Stock Exchange. Sensex is the flagship index of Bombay Stock Exchange. National Stock Exchange, Bombay Stock Exchange. So Nifty is a combination of the top 50. It is an average price of the top 50 companies of India. Average. Sensex is an average price of the top 30 companies of India. And they're more or less the same. Nifty and Sensex are more or less the same, right? So we'll just talk about one of them. So let's talk about Nifty here, okay? And Nifty is a combination of the top 50 companies. So it is an average price of the top 50 companies of India. And if this average is going down, the market is not doing that well, future doesn't look that great, and economy is kind of, not doing that well, right? Now, in case if the average of the top 50 companies starts to go up and it's going up, that means economy is doing well, future looks bright, and stock market is doing wonderfully well, right? So it just tells you what the economy is looking like, what the future is looking like. So it is an average of the top companies. And if you talk about Nifty, it is an average of the top 50 companies. Companies like Reliance, you'll have HDFC Bank, you'll have companies like Infosys, TCS, companies like ITC, ICICI Bank. You must have heard about all these companies, SBI. You'll have companies like Maruti, right? Asian Paints, all these companies, right? And they have a specific weightage in Nifty. So Reliance, HDFC, all of them would have a specific weightage in Nifty. So Reliance would probably have a weightage of, let's say, around 13%. HDFC, let's say, 12%. Infosys, another 12%. Let's say TCS, 10%. ITC, 8%. Another 8% for ICICI Bank, and so on. So if you want to invest in index, let's say you wanted to invest 10,000 rupees, what you would do is you will divide your money into the 50 companies as per the weightage, right? So this 10,000 will get divided into all these companies. So 13% will go to Reliance, so around 1,300 rupees will go to Reliance out of the 10,000. HDFC Bank will get 12%, which is 1200. Another 12% for Infosys, so another 1200 goes here. 10% for TCS, so 1000 goes here. 800 goes here. This is how you distribute your money into the different companies, right? But the problem is that this number will keep changing after every couple of months, right? Maybe after a couple of months, you can have Reliance unchanged, but let's say HDFC Bank goes down by 1%. Infosys remains unchanged. ITC, let's say, goes up by 1%, right? Then what you would need to do is you need to sell some shares, buy some shares, and you need to keep rebalancing it. But do you think it's easy? Do you think it's easy to track all this, to keep buying, selling shares? Do you think it's easy? Yes or no? Do you think it's easy? Yeah. Yes or no? No, it's not. It is quite tedious to keep tracking all this. It's not easy at all. So what is the solution here? What is the solution here? Well, the solution here is something called ETF, right? ETF, what is ETF? ETF, right? Just type in ETF in the comment box, yeah? Type in ETF in the comment box. That is the solution. What is ETF? I'll tell you. Just type in ETF in the comment box. ETF is Exchange Traded Fund. Exchange Traded Fund. Now, what is Exchange Traded Fund? Well, Exchange Traded Fund will do this on your behalf. You don't have to do it. You just have to give them the money and they will do this for you. What they do is they hire a fund manager, okay? And this fund manager uses 0% of his brain. He's not using any part of his brain when he's investing your money. Why? Because he already knows where to invest and he already knows how much to invest. All this information is publicly available. It's there in the public domain. He knows where to invest, how much to invest. He's not using any brains. And since he's not using any brains, do you think ETF, will they charge more or will they charge less? They're not using any brains. So will they charge more or will they charge less? They'll charge less, right? Why would they charge more? They're not using any brain. All this information is publicly available. They're just implementing it for you, executing it for you. They won't charge much, right? So I'll tell you how much ETF charge. ETF will charge as little as 0.07%. Now compare this with the mutual fund, okay? The equity mutual fund, you know how much do they charge? They charge as high as 1.5%. Look at the difference between what they are charging, and majority of the mutual funds fail to beat the index. Mutual funds which are doing well right now may not be in the top 10, 15 mutual funds 7-8 years from now, 5 years from now. Because if you look back 5, 7, 8 years ago, the mutual funds which were doing well are nowhere to be seen now. And we have different kind of mutual funds right now, and they will keep changing. And to be able to beat the index over a long period of time is quite difficult. So without paying much to them, you can get you get to invest in the top 50 companies of India. Okay, so what you can do is you can invest in this ETF, right? Now tell me, if India is doing well, would the average of the top 50 company go up or go down? If India is doing well, economy is doing well, would the average of the top 50 company go up or go down? Tell me in the comment box. Yeah, it'll go up, right? It will go up. Right now, tell me this, answer this for me. How many of you believe that our country, India, will continue to grow? And 3, 4, 5 years from now, we'll have better lives, we'll have better economy, our own life would be better. And this growth that we are witnessing right now is not there for just 5, 7 years. It'll be there for 15, 20, 25 years. Just type in India in the comment box if you believe that our country, India, will continue to grow. Just type in India in the comment box. Yeah. Right? Just type in India in the comment box if you believe that our country, India, will continue to grow. Now, if you believe that our country, India, will grow, then what you can do is by using 0% of your brains, okay? By using 0% of your brain, you can invest in India's growth. How? By investing in something called Nifty ETF. What is Nifty ETF? All they do is they would invest your money into the top 50 companies, right? The money goes to the fund manager who uses 0% of his brain because he already knows where to invest. So you are not using your brains. Your money is given to the fund manager who's not using his brains, and you get 14, 15, 16% kind of returns. So without using any brain, you can participate in your own country's growth and get that 14, 15, 16% kind of return, right? Now, what we are doing here is we are learning, okay? We are learning. And since we are learning, we want slightly more. Because if you do not even use your brains, you can get that 14, 15, 16% kind of returns. But when we are learning, we want slightly higher rate of return because we are learning, right? So we'll be happy to get 22, 23, 24% kind of returns, right? We'll be happy to get this kind of returns, right? Now, if you're growing your money by 23, 24%, how much time will it take you to double your money? Again, we'll be using rule of 72. Rule of 72 says that if you divide 72 by the rate of returns, you'll get to find out how much time it will take you to double your money, okay? So if you divide 72 by the rate of return, 72 divided by 24, let's say, you'll get the answer as 3% or 3 years. So in about 3 years, you'll be able to double your money if you're growing it by 24%. If you're growing it by, let's say, 23%, then again, close to 3 years, you'll be able to double your money. Let's say if you're getting 22%, in about 3 years, again, you'll be able to double your money. So you'll be able to double your money in about 3 years, right? So if you're growing your money by 23, 24%, that's pretty good, right? Now, how much would 10 lakhs be in about 10 years if you're growing your money by 23, 24%? How much would 10 lakhs be in about 10 years? Give me a rough idea. How much would 10 lakh be in about 10 years if you're growing your money by 24%, right? 30 lakh, somebody's typing in 30 lakh, 80 lakh rupees, 35 lakh, 50 lakh, 80 lakhs, 1 crore, 90 lakhs, 80 lakhs, 60 lakhs. So let's calculate this, okay? So we are at the 0-year mark and we're looking at 10 lakh rupees here, okay? So we are at the 0-year mark and we're looking at 10 lakh rupees, right? This is what we are looking at. And what we're doing is we are doubling our money every 3 years. So 3 years, 6 years, 9 years, and 1 more year, 10 years, right? And let's say we are, doubling it every 3 years and growing it by 23, 24%. So 3 years, in about 3 years, this 10 lakh will be 20 lakhs. Another 3 years, this 20 lakhs would be 40 lakhs, right? It'll be 40 lakhs. Another 3 years, this will double again. It'll be 80 lakhs, right? And 1 more year of compounding, let's say 1 more year of compounding, let's say we get 25% return there, 1.25, 25% return, and we are compounding 80 lakhs. So that'll be 1 crore, 100 lakhs. So we started with 10 lakhs, and in about 10 years, that can be 1 crore because that is the power of compounding, right? It can be 1 crore. And this return would not be linear. This, this 22, 23% return, it would not be linear. In between there'll be ups and downs, but on an average, if you're getting 22, 23%, like in ETF, you get that 16% return, it doesn't mean that you're getting this return every year. It is linear, not linear. You probably get negative 20% in 1 year and 45% the next year, then maybe negative 5% next year, and then positive 50% the next year. On an average, around 15, 16%. Now here, since we're learning and we're getting around 23, 24%, then this is what you can do, right? This is the power of compounding that I want you to understand, right? And there is this gentleman called Warren Buffett. How many of you know about this gentleman called Warren Buffett? Just type WB in the comment box if you know about this gentleman, Warren Buffett. Yeah? Type in WB in the comment box. Now, he is a billionaire investor and he has been compounding his money for over 50 years. He has been compounding his money for over 50 years. And that's why he has become incredibly rich, because he has been able to compound his money for a very long time, right? But I don't want you to keep compounding for 50 years and then die one day. That's not what we want. We want to enjoy life as well. We just don't want to keep compounding for 50, 60 years and then die. We want to enjoy life, but let's just stretch it a little bit, not till 50 years, but let's just stretch this and see how much the money can grow. So we are doubling it every 3 years, 3, 6, 9, let's say 12 years, 15 years, 18 years, 21 years, and let's see what this amount can be, right? So in about 3 years, it'll double again. So it'll be 1.6 crore. Another 3 years from 12 to 15, this will double again, 3.2 crores, 6.4 crore, 12.8, and so on and so forth, right? But what I want to tell you is that even a small amount, let's say you invested 1 lakh, in about 20 years, there can be 1 crore. This is I want you to understand. Now, if you interrupt this process of compounding, then you're doing a disservice to yourself. You are not, utilizing the power of stock market if you keep interrupting this process of compounding, right? So I'll give you an example now. Let's say if somebody invested and in about 4 years or 6 years, the money grew from 10 lakh to 40 lakh, 4 times. And if this person checks out because he wants gratification, he wants to enjoy that money, right? And if he checks out here at the 6 year mark, maybe with 40 lakhs, he can buy a car, maybe go out for a vacation or two. That's all you can do with 40 lakhs, not much, right? But if he chooses to wait for slightly more duration, let's say 6 more years, look what he gets. He gets 4 times more, 1.6 crore. From 40 lakhs, 1.6 crore. And this is the amount that can give you the financial freedom. 40 lakhs may not be able to do much for you, but 1.6 crore can really give you financial freedom. And we'll talk about financial freedom later on. But this is what can happen if you don't interrupt that process of compounding. People want to enjoy first, okay? And they don't want to delay their gratification. They want instant gratification. They want to enjoy right now, instant. And anything which is instant is not good for you. You put sugar in your mouth, instantly you feel good. Is it good for your body or your health long term? No, it's not. Let's talk about fast food. It's instant, right? But is it good for you if you eat it every day? No, it's not. So you got to see what are you compounding in your life, because your good habit compounds, your bad habit also compounds. What are you compounding in your life? And something that doesn't give you instant result is good for you. You exercise for one day, nothing happens. Maybe you'll have sore body and you probably feel the pain. But if you keep doing it every day or every day and do it for long term, it has your health, it has that health benefit. Let's say you eat a donut one day, right? Nothing will happen. And since nothing has happened, you might as well do it the next day and the next day and the next day. What will happen? You are compounding something that is bad for you, right? Similarly, you eat a good healthy food once, nothing will happen, right? But if you keep repeating it every day, you'll have better health, right? So everything compounds. Your bad habit compounds. Your good habit also compounds. Your knowledge compounds. So all you got to do is you got to make sure that every day you learn something. When you go back to bed, you should be slightly wiser than what you were when you woke up. And if you keep doing this, all you have to ensure is that whenever you're going to the bed at night, you're slightly wiser than what you were when you woke up, and you keep doing it, your knowledge is compounding like this, right? So everything in your life compounds, right? Your money compounds, as you can see. Your money compounds, your habits compound, your knowledge compounds, and your relationship also compound. Now, if you're neglecting your family and you neglect them for a day, nothing will happen. You do it for a week, for a month, maybe a couple of months, they'll understand. But if you keep doing it, you'll have problems, right? So everything compounds, your relationship compounds, and you got to understand this. What is it that you are compounding in your life? Are you compounding the good things in your life or the bad things in your life? You may not realize because, eating that donut doesn't make a difference to you and you want to do it again the next day. You need to realize that you only need to be compounding the right things in your life. Now, rich people understand this. Wealthy people understand this and they're willing to wait. They're not willing to enjoy right now, and they're willing to wait because they know that in the future they'll have much more, right? So look at this. They will not take out the money here because they know they can get much more in the future and then they'll enjoy, right? So they understand the power of delayed gratification, right? Just type in PODG. PODG is power of delayed gratification. Now, power of delayed gratification, this really is the superpower of rich. And you better understand this. To delay the gratification, anything that's giving you instant result, pleasure, is not good for you. Not good for you, not good for your future. Avoid it. Understand the power of delayed gratification, even in stock market when it comes to investment. Yeah. So that is the point number one that I want you to understand. The point number two is that there's always an opportunity available here in the stock market. You'll never miss the bus. You'll keep getting opportunities here. Now look at this. Now this is the chart for Nifty. Now let's say you missed an opportunity. Let's say you could not really invest in this 2000 crash and the market went up, and you got the opportunity again in 2001, 2, 3. You missed it. You got the opportunity again in 2004. You missed it, you got the opportunity here in 2008, 9. And quite recently, we got the opportunity in March 2020. So you'll keep getting opportunity here. And this is the best part about the Indian stock market, that Indian stock market is very forgiving. Now, what do I mean by this, that Indian stock market is very forgiving? What I mean is that even if you make mistakes here, you'll be fine. So look at this. Even if you make mistakes here, even if you invest at the worst possible time, let's say right here, right at the peak of 2008, if you invested here, the market went down, right? But if you had a long-term horizon, you would have made money. Let's say you invested here right at the peak of 2015. The market started to go down and it fell. It was in a downtrend for the more than a year. But if you had a long-term horizon, you would have still made money. Now let's talk about the latest one. In January 2020, let's say you made a new resolution that, okay, I'm not now going to invest my money in the stock market. And right here, you invested right at the peak. Nobody knew that the pandemic is coming. And in January 2020, you invested. And the market collapsed. Look at the way it fell. It fell in a straight line. Never, ever it has fallen like this. Look at this. It never fell like this in 2015. In 2011, it fell and went up, fell and went up. Same thing happened in 2008. It fell, went up, fell and went up. Here it fell in a straight line. But if you invested here, but you had a long-term horizon, you would have still made money. Look where the market is now. So you'll keep getting opportunities here. And the best part is that Indian stock market is forgiving. Even if you make mistakes, you'll be fine. As long as you just don't keep making mistakes. If you keep making mistakes here, then you deserve to lose money. Okay. So don't just keep making mistakes here. 1 or 2 times you make mistakes, you'll be fine, right? Number 3 is, how does the money compound in the stock market? So when I say the money is growing from 10 to 20 to 40 to 80, how is this money growing? Right? We'll understand about the compounding when we talk about the 3 secrets here. Okay, the 3 secrets. And these 3 secrets are needed for you to succeed in the stock market. Okay. And the 3 secrets that we'll be learning, the secret number 1 is when to buy. What is a good time to buy? Now, here we'll be talking about how do you identify that now is a good time and we should buy, because things would not be good when the price is low. There is a reason why the price is low, because things are bad. And that's why the price have gone down, right? So that'll be the secret number 1, when to buy. Secret number 2 would be what to buy. After you've identified a good time to buy, we also need to know what to buy. What is it that we need to invest our money in? We would be talking about where do you find these stocks. We'll be talking about the names of the stock that you can consider investing in. Secret number 3 would be the strategy that one needs to have, because if you follow the crowd, you'll never get the results. Crowd is never going to make money here. And if you do what the crowd does, then you will also not make money here. So what kind of a strategy we need to have is something that we'll be learning in the secret number 3. Okay. And yeah, this will help us build a super profitable stock portfolio. And this is little something about myself. So my name is Modit, and I've been training in some of the leading brands in India like ICICI, National Stock Exchange, and some of the leading colleges across India. And I have a community called the Freedom Investors Hub. It's a community of more than 12,000 now, 12,000 traders and investors. Okay. And later on, I'll tell you how you can be a lifetime member and join the 12,000 plus members here, because I would never recommend anyone to do this alone. Doing it alone in the stock market can be hard. It can be painful. It can lead to a lot of losses. I would never recommend you to do this alone. Here you can join the 12,000 plus members and learn together and do things together. Okay. That's something that I'll tell you later on how you can be a lifetime member in the Freedom Investors Hub. But first, just learn about the three secrets here. And the secret number one that we would be learning and we'll be talking about would be when to buy. What is a good time to buy? So, what is an ideal time to buy? See, if you use your brain, you'll never be able to identify that time because your brain will tell you to wait because things are bad. And that's why the price is low. And brain will tell you to wait for things to improve. And by the time the things improve, the price will go up, right? So you need a system here. If you just rely on your brain, you'll never be able to make that decision. You need a system here, right? What is the system? Economic cycle. This is what we look at. What is economic cycle? What kind of economic cycle we're talking about? So there are four economic cycles that economy goes through, and they are recovery, boom, slowdown, and recession. And it is a cyclical process. So after recovery comes boom, then slowdown, then recession. Then again, recovery, boom, slowdown, and recession. And if you can identify the characteristics of each economic cycle, then you'll be able to know what's going on right now, what is it that you need to do, what to buy, and what to expect in the future. It'll also give you that forecasting abilities as well. Now, these are the same principles that I've been teaching in ICICI, National Stock Exchange, and it's helping thousands of traders and investors. And this is really going to help you. This will help you become an independent investor. How many of you want to be an independent investor? Just type II in the comment box. II is independent investor, right? And this really will help you become an independent investor. You will be able to take decisions. You will not be clueless, and you will precisely know what's happening right now. Okay. So let's start with the recovery phase. Okay. Let's start with the recovery phase. Understand what all things that happen in the recovery phase and what we can buy. Okay. So what are the characteristics that we'll see in the recovery phase? This is what we'll observe. We'll have wall of worry. Wall of worry is that people would be worried about their circumstances. They'll be worried about their future. They'll be worried about their kids' future. Now, why would people be worried? People would be worried because prior to recovery, we were in a recession. And in recession, things are bad. People are losing jobs, unemployment all around. All this will happen, right? However, there are these subtle changes in the economy that tell you that now we are moving from recession to recovery. Now, what are these subtle changes that we'll observe? This is what we'll observe. So we'll have falling interest rate. Interest rate will start to go down. Okay, interest rate, RBI. RBI will cut the interest rate. When RBI cuts the interest rate, what happens? The loan becomes cheaper. It's easy to take loan because interest rates have gone down. People start taking loan, and when people take loan, they spend that money. And when people spend, companies are able to sell more. They're able to sell more of their products. Their sales go up, their profit go up. As a result, their share price will start to go up. So you'll have a scenario where interest rates are falling, stock market is rising, and you'll have falling economic resources. And if you happen to observe this, that means it is a sweet spot to buy. Buy, and why? What do you buy? This is what we'll do. We would buy mid and small cap stock and value stock. Now, value stock is investing in the undervalued companies. You can also be putting your money in the mid and small cap stock. And mid and small cap stock are the medium-sized, small-sized company. The definition is the market cap. Now, market cap, as the formula over there says, it is the stock price into the total number of shares. So stock price into the total number of shares of the company, you multiply the two, the current price of the stock and the total number of shares of the company, you get the overall value of the company. And if the market cap of the company is above 25,000 crore, it's a big company, it's a large cap company. Anything below 25,000 crore is a mid and small cap company. So you can be putting your money in the mid and small cap company, but 20 to 30% only. 70 to 80% of your portfolio should be with the large cap, big companies. 20-30% can be allocated towards mid and small cap in the recovery phase. And then comes boom. This is where economy is booming, things are looking great. And what are the characteristics that we'll observe? This is what we'll observe. We'll have rising overseas reserves. easier money. So people were taking loan. RBI had kept the interest rates low. Interest rates are still going low. The RBI is cutting the interest rates, and we have easy money available. People are taking loans, spending money. People feel comfortable taking loans because economy is doing well. They have jobs. They have job security. They can change jobs, get more salary. So people are spending their salary. They are taking loans, spending even more. So people are spending here. Companies are able to sell more. This is like the best time for the economy. Things are good. People have the loans. They can take loan. And since people can take loan, even real estate will do well because people will take loan, buy a house of their own, right? And you'll have euphoria about economy and stock market. People will feel good about themselves because they have access to money. Money is available. They have jobs. They can take loan, get more money, and people are happy. And if you happen to observe this, it's a bull market that we are in. Buy more and stay invested because stock market is doing well. Buy more of the stocks. Now, what to buy? Now, here we are talking about the bigger picture, right? We would be talking about the names of the stocks in the secret number 2. Right now, we're talking about the bigger picture, the sector, industry, all that. We will talk about the names of the stocks in the secret number 2. So here in the boom phase, what do we invest in? We would buy cyclical stocks. Now, cyclical stock, as the name suggests, they are cyclical in nature. They would do well when economy is doing well, and they'll do poorly when economy is doing poorly. So when you have boom phase going on like you have here, what you would see is you would see that people are happy, things are doing great, people have money. And if people have money, what will they buy? They would buy electronics. They will splurge their money on traveling, eating out. So restaurant stocks will do well. People are traveling. So you'll have airline stock. You'll have hotel sector doing well. People are consuming more, right? If they are consuming more, FMCG, fast moving consumer goods, all these sectors will start to do well. Real estate will do well. Of course, you'll have people buying car or two-wheeler. So auto sector, because loans are available, people will take loan, buy a car or two-wheeler. All these sectors will start to do well. And then comes the slowdown. And this is where economy comes to a halt. And we get into a downtrend. Things were good up till now. And from here on, the downtrend starts, right? So if you look at, if you look at what has happened so far is in the month of March 2020, we had the market making a low of around 7,500, right? And then in October 2021, it made an all-time high of 18,604. So the market has gone up quite a bit, right? Market has gone up quite a bit. Now, if it has gone up, it'll go down too, because market moves in cycle. If it has gone up, it'll go down. And if it has gone down, it'll go up too, right? So the market moves in cycle and there will be a downtrend in the future, right? Now, won't it be nice if you can get to find out when would that slowdown come? How can you identify that slowdown? Won't that be nice? Just type in nice in the comment box if you think that'll be a nice thing to know. Yeah. Type in nice in the comment box. And that's what we'll be learning now. How can you spot that downtrend? What are the characteristics that we would be observing? This is what we'll be observing. So we'll have rising interest rate. Interest rate will start to go up, right? Now, why? Why would RBI increase the interest rate? Well, RBI will increase the interest rate because of all that buying that was happening, because of all that money that was available, because of all that demand. The price will start to go up. And RBI doesn't want too much inflation. RBI doesn't want price to go up too much. It doesn't want too much inflation. So what RBI will do is RBI will start to increase the interest rate. And what happens when interest rates go up? When interest rates go up, loan becomes expensive. Not many people will come forward to take the loans. Those who had already taken loan, they're paying EMIs. So their spending capacity has already gone down. New people are not taking enough loans, and overall, the spending in the economy will go down. The demand will go down. And since companies are not able to sell as much now, their share price will start to drop because sales are dropping. So you'll have a scenario where interest rates are rising, stock market is falling. And if you happen to observe this, you better be aware that we have a slowdown coming. Okay. And if slowdown is there, then what should we do? Should we sell everything that we have? should we sell it? Well, that's not what we do. We hedge the portfolio. So I'll tell you what we do here in the Freedom Investors Hub. I'll tell you what we do here in Freedom Investors Hub. This is what we do. In Freedom Investors Hub, we invest. Okay. So we invest, we build a portfolio. Okay. We do this long-term investment. And what we do here is on this investment, what we do is we generate a regular monthly income. We generate a regular monthly income, and this regular monthly income is not dividend income. It is not. It is not selling of a stock because it has gone up by 5-10 rupees. No, it is a regular source of income for us. Okay, and we take 0% additional risk. Okay, we take 0% additional risk in order to generate this regular monthly income, right? So it is not a dividend income. It is not buying, selling of a stock, and we don't take any additional risk. Whatever the investment risk is there, that's the only risk. In order to generate this monthly income, we don't take any additional risk, right? Now, we call it RMI, regular monthly income. How many of you like this idea of regular monthly income? Just type RMI in the comment box. RMI is regular monthly income, RMI. Yeah, just type in RMI in the comment box. Yeah, because we generate a regular monthly income on the portfolio that we have. We never sell our portfolio even in a downtrend. What we do is, this is what we do. We hedge the portfolio. Okay, hedge. What is hedging? It is protecting, right? It is protecting portfolio, protecting the portfolio, right? I'll tell you what that is. Protecting the value of the portfolio. It's like an insurance, right? Just like we have car insurance, that in case if something happens to the car, we get reimbursement, right? Similarly, we can have something that can protect our portfolio, that in case if the market goes down, the portfolio of course will go down, but we'll be able to get some reimbursement from here, right? That's something that we keep doing in case if the market is not looking that great. It's something that you can learn, right? It is something that you can learn, and you must learn how to protect your portfolio in case if the market starts to go down, and you must learn how to generate that regular monthly income. It's not rocket science. Anyone can learn this, and you can also learn it, right? So since we generate a regular monthly income, we don't sell our portfolio, we hedge our portfolio. Now, what to buy? In the slowdown phase, what do you do with the money that you're earning? First is, when we know that there is a slowdown, we first hedge a long-term portfolio. And once we have done that, we would then buy short-term government bonds and short-term debt mutual fund. Okay, so the new money that we are earning from our business or from our job, that we are putting in the short-term government bonds and the short-term debt mutual fund. And then comes recession. This is like the ugliest phase, and this is what we'll observe here. Falling overseas reserves, rising unemployment, prevailing high interest rate, and right at the depth of recession, right at the bottom before it starts to pick up again, right at the bottom, what we'll observe is that interest rate will start to go down again. Now, why? Why would RBI cut the interest rate here? Well, RBI will cut the interest rate because of all that recession that's going on right now. It wants to end the recession, and it can end the recession by cutting the interest rate, by increasing the demand. And the demand can be increased in the economy by making the loan available at a cheaper rate. So people will take loan and buy more things, right? So you have right at the depth interest rates going down, telling you that RBI is trying to end the recession now. And that's a good news, right? So if you really look at it, what happened was that RBI had started to cut the interest rate, right? It had started to cut the interest rate, right? By how much? It had cut the interest rate by 0.75%. It had cut the interest rate by 0.75%. And when did it do that? When did the RBI cut the interest rate? I'll tell you the exact date. On 27th of March, 2020, they had cut the interest rate by 0.75%. Where did the market close the next day? After the interest rate cut, where did the market close the next day? Type this in. Market closed at 8,200. Type 8,200 in the comment box. This is where the market closed the next day after the interest rate cut. And on 19th of October 2021, it made an all-time high of 18,604. So the market went up quite a bit after the interest rate cut. And how much did it go up by? Let's calculate. It went up by 2.3 times, right? 2.3x. That's pretty good, right? It went up by quite a bit. And we got this clue. And we started buying. There was gloom and darkness all around. Nothing looked good. If you remember, when the interest rates were cut, we were in a lockdown. We had recently gone in a lockdown and things looked horrible. We thought that future would be even worse because it has just started. But the market started going up. We thought that the bad time is now coming, but the market started to go up. And we got this clue and we started buying. And not that small little investment that crowd does, not that small little monthly investment. No, I'm talking about a big chunk of investment that can really move the needle on that net worth scale. That's what I'm talking about, right? So we started investing. And where did we invest? This is what we invested in. We bought growth stocks, rate sensitive sector, and corporate bonds. Now, corporate bonds are fixed income instrument. They're like fixed deposit. As far as stock market investment is concerned, we started buying growth stocks and rate sensitive sector. Growth stocks are the market leaders, the big companies, the leaders of their sector. For example, in the banking sector, you'll say SBI, HDFC Bank, ICICI, all these Kotak, all these banks are the leaders. Similarly, who do you think is the leader in the IT sector? What name comes to your mind? Who's the leader in the IT sector? Yeah, you'll say Infosys. Yeah, you'll say TCS. All these sectors, right? Now, we started buying this, and we also bought the rate sensitive sector. Rate sensitive sectors are those sectors which get impacted by interest rates going up and down. Now, in recession, RBI is expected to keep the interest rates low because it's trying to revive the economy. And if interest rates are low, which sectors can benefit? Of course, the banking sector, because people will take loan from the banking sector, real estate, construction, manufacturing, you'll have FMCG, auto, all these, metal sector, all these sectors will start to benefit. And this is where you can put your money. And now an important question for you. Which phase do you think we are in? Recovery, boom, slowdown, or recession? What do you think? Which phase are we going through right now? Right? Slowdown, recovery, boom. I've got all sorts of answers here. But I like to believe that this is what's happening right now. We are in that slowdown phase. So we were in that boom phase. Things were looking great. We were in that boom phase, but we have entered into the slowdown phase now. And now how to identify that slowdown. How would you identify the slowdown? What characteristics would you see that will tell you that the slowdown is there now? What characteristics would you see? The interest rates going up, right? But even before the interest rates will go up, you'll have inflation picking up. Because higher inflation tells us that we can no longer have this low interest rate scenario. So even before the interest rate starts to go up, you'll have inflation picking up. And for the last 5-7 months, have you been hearing about the inflation a lot more? Just type in I in the comment box if you've been hearing about inflation news a lot more. I is for inflation. Have you been hearing about the inflation news a lot more? Yes. And that has been happening for the last 5-7-8 months. Now, this tells you well in advance that we have a slowdown coming, right? And if you just segment the market this way, you'll never be clueless. People are clueless about the stock market, but you will never be clueless because you know this knowledge now. 5-7-8 months from now, 1 year from now, you'll have a different scenario. But right now, things are not great. We are in that slowdown phase, and now you know how to spot it. And you would precisely know when the economy is recovering again, right? So this knowledge that I've been, sharing with in ICICI National Stock Exchange. It's helping thousands of traders and investors, and this will surely help you as well because you need not be an economist to know all this. You just need to be observant of what's happening around you, and you will be able to find out what's going on, what is it that you need to do, and what to buy. This will give you that forecasting abilities. You'll get to know what to do right now, and this will really help you. Now, how many of you found it super useful? Just type in super useful in the comment box. Yeah. Type in super useful in the comment box. Yeah. If you found it super useful, because this will really help you. You will not be clueless. You'll always have an answer to what's going on right now. People do not have this knowledge. They are clueless, but you will never be clueless from now on. Yeah. Awesome. I'm glad that you found it super useful. We'll now be going to the secret number 2. Now that we have identified how to identify the economic cycles, the market cycles, we need to know where do we put our money? Where do we invest? So we would move to the secret number 2 now, okay, and start learning about where do we see these stocks, right? So secret number 2 is all about which stocks to invest in. Now, before we go there, let's just listen to this gentleman. He's part of the Freedom Investors Hub. We have more than 12,000 traders and investors here. Let's listen to what he has to say, and then we'll jump to the secret number 2.
And thank you so much. I mean, you're changing the lives of many people. And the way you teach, the way you conduct the sessions, the way you show your commitment. I mean, there are a lot of people who take a lot of money in the market, but it's not about the money. It's about what I see, that is the commitment from your side. And the very first session which I attended, it was like the introductory session. That is where I decided to enroll. And then I went through the Freedom Investors and I thought, no, even if I don't make some money, at least it's worth attending this session, because that is where you learn. And even if I don't make a money, this 12,000 rupees will help me to learn something, which is much more than the money that we are paying you. So it's a great job you're doing, and I personally want to thank you on that.
Thank you so much. So lovely to hear that.
All right, that 12,000 rupee that he was talking about is for the coaching system that I have, 12,999 plus the GST, and you get the lifetime access to the Freedom Investors Hub. But I'm going to give you a very special offer and a very special price. Okay, so we'll talk about it, how you can be a lifetime member in the Freedom Investors Hub. But first, let's just learn about the secret number 2. The secret number 2 is all about where to invest. But if you look at what the stock market has done, look at the way the stock market has gone up. This is the chart for Nifty. Okay, it has gone up. And why are people losing money when the market is going up like the way it has? Well, people are losing money in the stock market because of the kind of stocks that they're investing in. That's why they're losing money. Because if you look at the stock market 20 years ago, Nifty was around 1,000 in the year 2002. It was around 1,000 and it went above 18,000 recently. So the market has gone up by 18 times in the last 20 years, and yet people have lost money. How and why? Well, people have lost money because of the kind of stock that they invest in. You must have seen there are stocks that do not go up when the market goes up, but they are the first one to go down when the market starts to go down. So, we all at times have a lot of stocks in our portfolio that's not doing anything. They're not moving at all when the market is going up. They're not participating. But when the market starts to go down, they just drop everything and go down in a hurry. How many of you agree with this? Just type agree in the comment box. Market is doing well. Our stocks are not moving. But when market starts to go down, we see a lot of stocks going down by 5, 7, 8%, right? And this is the reason why we need to see, if you have a lot of stocks like this, only few stocks which are good. So these good stocks will not be able to make much difference to your portfolio. Overall return of your portfolio would still be bad. We got to change this. So first thing that we got to do is we need to stop investing like crowd, right? Stop investing like crowd. In fact, stop investing like crowd in the stock market, and stop living like crowd in your life as well. Because if you're part of the crowd in stock market, you lose money. In your life, in general life, if you are doing what the crowd does, you live an average life. And we don't want average. So we need to have something which separates us from the crowd, right? So you got to look at what kind of decisions you make, right? You got to look at, your life, whatever decisions you're making, think what the crowd will do in a similar situation. And what should you do? If your decisions are same as the crowd every time, then you are part of the crowd and you better not be part of the crowd. So think about your decisions. Whenever you're making a decision, think what the crowd will do. And then don't try and do those things. Mostly you'll be okay. Also look at what is it that the crowd doesn't want to do. And consider doing those things, because crowd is seeking comfort all the time. They want comfortable life all the time. They don't want discomfort at all, right? So look at what they are not willing to do. They're not willing to learn. But you guys are here to learn, which is awesome, right? Crowd is not into reading books. You start reading the books. Crowd doesn't want to exercise. You start exercising every single day. Crowd doesn't want to wake up early. They want to wake up at 8, 9, 10 a.m. on their week off. They want to take it easy. They want comfort. But you start waking up at 5 a.m. every single day, and this will change your life. Getting up at 5 a.m. every day will change your life, because crowd is not willing to do this. So you got to look at what the crowd does and don't do those things. Also look at what is that the crowd doesn't do and consider doing those things. You need to decide that you don't want to be part of the crowd, right? And only then you can live an extraordinary life. So just type in, I am not crowd. Decide today that you're not going to be part of the crowd. So type in, I am not crowd. Okay. Type in, I am not crowd, because we don't want to be part of the crowd. That is the starting of getting more than the average, not just in stock market, in your life as well. Don't be part of the crowd. Now, how not to invest like crowd? Let's talk about that. Okay. So how not to invest like crowd? That's something that we will be talking about now. Okay. Now, before I talk about that, let me just take you on to the YouTube channel of the Freedom Investors Hub. This is the YouTube channel of the Freedom Investors Hub. And as you can see, this is a verified account by Google. Okay. This is a verified account by Google, the Freedom Investors Hub account. And if you go onto our YouTube channel, you'll be able to see all these videos of people talking about, hundreds of videos of people talking about the Freedom Investors Hub, how they're building their portfolio, how they're generating that regular monthly income. Look at this. I can keep scrolling here. Look at this. I can keep scrolling here, and you'll see a lot of people talking about the Freedom Investors Hub and what we do here. Look at this. I can just keep scrolling here, right? And it'll have, look at this. And it'll have, all these useful videos as well. In fact, I'll give you the link for the YouTube here. You'll have all of these useful, videos as well, in which you can just use Excel, okay? Excel to track your portfolio in the live market. In the live market, you can track your portfolio. You can see the exact P&L of your portfolio by looking at the Excel in the live market. The price will move up and down. You can set it up just by using Excel, nothing else. And if you're interested in technical analysis, there is a free video here that you can use, and in fact, a free tool as well that you can use, and you can get to learn that how to use that tool in this video. So I'm going to give you the two links, okay? And I'll give you like 10-15 seconds to click on the link, okay, and subscribe to both. I'll give you the link for Instagram as well and the YouTube. On both, you'll get some useful information. So click on both, subscribe to both, and come back and type in done in the comment box once you've done it, okay? So here are the two links, YouTube and Instagram. And also, what I'll do is, in case if you're looking to open a DMAT account, or your DMAT account is charging you way too much brokerage, okay, I'll give you two links. The one that I use, okay, Zerodha and Upstocks. This is what I use, Zerodha and Upstocks. Yeah, you can click on them, and once you click on Zerodha, it'll ask you for your phone number. Enter the phone number there, enter the OTP and all. You can open an account here using these links, right? Awesome. Yeah, super. Okay, great. So here is the link. Yeah, once again. Yeah. All right. So now let's talk about how you can invest and not be part of the crowd, right? So let's talk about that. Right. So now, if you look at the stock market, there are so many number of stocks that you can really look at, right? There's so many number of stocks. So if you look at all the stocks, so we have 5,000 plus stocks, right? We have 5,000 plus stocks. in National Stock Exchange, even more in the Bombay Stock Exchange, around 7,000. And in order to build up a portfolio that makes money for you, all you need is 10 to 12 stocks. That's it. You just need 10 to 12 stocks, and you'll be able to build wealth for yourself. And not just for yourself, you'll be able to build wealth for your next generation and a generation after that and a generation after that. Generational wealth. How many of you are here to build generational wealth? Just type GW in the comment box. GW is generational wealth. And stock market is a place where you build generational wealth. Yeah. So just type in GW in the comment box. Yeah. Right. Yeah. And how you can do this is by just looking at 10, 12 good stocks, and that's about it. Right. And the idea here, when you're investing in the stock market, the idea here is to not get the best returns possible. It is not to beat your neighbor's return, your friend's returns, or any of your family members' returns. No, that's not the idea. When you're investing in the stock market, the goal that you need to have is this. Your goal should be this, BTM. Okay, just type in BTM in the comment box and I'll tell you what this is. Okay, type in BTM in the comment box. And yeah, here's the link again for the opening of the Demat account. Somebody was asking for it. Okay, yeah, just type in BTM. BTM is beat the market. BTM is beat the market. That's our goal, to beat the market. Now, what does it mean? It means that if the market has gone up and has given 15% kind of return, and our stock portfolio has given 25% return, we are happy because we managed to beat the market. Similarly, if the market has gone down, let's say if the market has gone down by 15% and our stock has gone down by only 8%, we are happy because here too, we managed to beat the market. That's all we need to do. If the market has gone up and if our stocks have gone up much more, we are happy. And if the market has gone down and our stocks are falling less, we are happy. And that you'll be able to do by selecting a good 10 to 12 stocks portfolio. And that's about it. You'll be able to build generational wealth. You'll be able to beat the market. More importantly, you'll be able to sleep well at night, knowing fully well that you have invested in good quality stocks and you don't need to worry and you'll make money, right? But if you look at the 5,000 stocks, you'll never be able to do that. So what you need to do is you need to narrow down your search, right? So we talked about Nifty 50 at the start. We talked about Nifty 50, right? Nifty 50 is the top 50 companies of India, right? And then we have something called Nifty Next 50, okay? There's something called Nifty Next 50, which is the next 50 companies of India. So top 50 is from 1 to 50. Next 50 is from 51 to 100. Put together, we're looking at the top 100 companies of India, okay? And the answer to that perfect portfolio is here in the top 100 companies of India. You don't need not look at the 5,000 stocks that are there. All you got to do is just look at the top 100, and out of the top 100, select 10, 12 good companies, and that's it. You've done your bit. You've done your job. You've selected a portfolio that will make generational wealth for you. You'll be able to beat the market. You'll be able to sleep well, and you will be able to create enormous amount of wealth for yourself and the next generations, right? Just by selecting good 10, 12 stocks out of the top 100, right? The top 100 should be your investment universe, right? So just type in top 100 in the comment box, yeah? Type in top 100 in the comment box because that is your investment universe, right? Now I'll show you Nifty 50 companies. There's something called Nifty Next 50 as well. Let's just look at one right now. Let's look at Nifty 50, okay? Let's look at the Nifty 50 companies here, okay? Let me show you this. Nifty 50, and I'll show you the number one company of India, okay? I'll show you the number one company of India. Just give me a second. I'll just share my screen and I'll show you the number one company of India. Okay, the number one company of India right now is, there you go. So the number one company of India right now is Reliance. Reliance is the number one company of India, and Reliance has been an amazing, amazing wealth builder. Now, if you look at the list here, look at this, HDFC Bank, another amazing wealth builder. Infosys, some of you would be working in Infosys, or you would know someone who works in Infosys. If I go down, ICICI, TCS, Kotak, all of them are wealth builder and pretty well-known brands, right? ITC. You would be familiar with this company. It's an FMCG company. If you go down State Bank of India, more than 100-year-old bank. If I go down Asian Paints, every time we think of getting our house painted, we think about Asian Paints. And we also have ICICI Bank here. How many of you have your ICICI, your bank account in ICICI? Yeah, just type in I in the comment box. Yeah, you'll be able to see the screen. You just got to zoom out. Okay, you got to zoom out. You'll be able to see the screen. Yeah. Yeah, quite a lot of you have your bank account in ICICI, and there is a phenomenal story building up in ICICI, and it's a great investment. But I would want you to do your own research. Don't go as per what I say. You do your own research. Okay, it's not a stock recommendation at all. Okay, so you do your own research. And if you go down here, Maruti, it probably was the first car for most of the Indians, right? So we have some amazing names here, but people look at these companies and they say, oh, the best time to invest in these companies was many years ago. And they don't invest in these companies. Reliance, for example, the IPO for Reliance came in 1977. And people in 90s were thinking Reliance was such a good investment at the IPO time. And they were thinking that was a good time to invest. They were not looking to invest in Reliance then. People in 2000s were thinking then back in 90s, it was such a good time to invest. In 1992, when we had that liberalization, Reliance was such a good investment. So they're looking at 8-10 years ago, it was such a good investment. And guess what people in 2010 were thinking? They were looking back at 2000, 2001, 2, 3, and they were thinking, what Reliance was such a good investment early on. It was available at such a low price. And it was a good time to invest. They were not looking to invest in Reliance at that point of time. Guess what people in 2030 be thinking? They would be looking back and be thinking that Reliance was such a good investment in 2020, 21, 2, 3, 4, and it was available at such a good valuation, and one should have invested in Reliance back then. So people look at these good companies and they think that the best time to invest in these companies was many years ago. What they fail to realize is that if India is growing, these are the good companies, these are the top companies that will be able to maximize that growth. They'll be able to take the maximum advantage because they are in that position. They were in that position 20 years ago, and they are in the same position. People are making the same mistake that they did in 80s, 90s, 2000, 2010, 2020. They are thinking these companies have done well. Now let me look for next Reliance, a small company that can be the next big thing, a small bank that can be the next HDFC. Yeah, this is what they're thinking, right? And since they're thinking all this, they are missing out on the current opportunity. Now look at this, okay? I'll show you the returns for some of these companies, okay? Let's look at Reliance, for example, okay? The number one company. And see, we look at the last 1 year return, and the idea here, when we're looking at the returns, the idea here is to beat the market, right? If the market has gone up, our stock should have been able to go up much more. If the market has gone down, our stock should be falling less. That's all we need, right? So let's see what the market did in the last 1 year, okay? Or let's say also the Reliance, what it did in the last 1 year. So the market went up by, let's see, the market here went up by 5%, and we have Reliance going up by 17%, 3 times than the market return. That's what we want. We want the market beating returns. And that's what you get when you invest in these good companies, right? Now, a lot of you have your bank account in ICICI. Let's see what the ICICI did in the last 1 year. Market gave 5% return. Did it manage to beat that? Yes, it did. In fact, it gave more than 4 times, almost the 5 times more return than what the market did. It gave 24% return. Also look at SBI. This is like a more than 100-year-old bank. What did it do in the last 1 year? When the market gave 5% return, it gave 27% return. That's what we want. We want the market beating returns. Let's look at Asian Paints, right? Again, you'll be familiar with all these names. Let's look at what it did in the last 1 year. So it gave double the return. We are happy with it. As long as we have the market beating returns, we are happy. Now, out of the 10, 12 stocks, 1 or 2 stocks, if they do not do well, even if they give slightly negative return, it's okay. Overall, we'll be able to beat the market, right? So let's look at what ITC did in the last 1 year. So ITC, look at this, it gave 10 times the return. Now, even if some stocks in our portfolio do not do that well, this stock, some of the stocks will give outstanding returns and they'll be able to make up for that, right? Now let's look at one more. Let's look at an auto sector. Let's say Maruti, okay? Let's look at Maruti. We can look at M&M. There are a lot of companies, right? Let's look at the last 1 year return for Maruti, and it managed to beat the market's return by 6 times. 6 times, right? Now, people will look at the share price and they'll say, oh, this is too expensive. I can't buy it. That's what they're doing, right? What they do is they would look at the share price, okay? They would look at the share price and then they look at the capital that they have. So let's say they have a capital around 10,000 and they look at the share price. Let's say the price is 2,000. They'll calculate how many number of shares they'll get, right? How many number of shares they're going to get. They calculate this. 10,000 divided by 2,000. So they'll say, I'll only get 5 shares. And then they look at this 50 rupee company. And they'll say, if I put my 10,000 here, then how many number of shares will I get in this 50 rupee company? And they'll say, oh, I'll get 200 shares. Then clearly 200 shares are better than 5, right? So what do you think they'll do? They'll buy the 50 rupee company because they're getting 200 shares here, right? And this does not make any sense. This does not make any sense. I'll tell you how. Now, let's say you have 20,000 rupees with you, okay? Let's say you have 20,000 rupees with you. Just type in 20K in the comment box, yeah? Type in 20K in the comment box. Let's say you have 20,000 rupees with you. And what you do is you split this into 2, right? 10,000, right? 10,000 you invest in this 2,000 rupee company and get 5 shares. The remaining 10,000 you invest in this 50 rupee company and you get 200 shares here. So you got 5 shares here and you got 200 shares here. And let's say at the end of the year, you got 10% return in both, okay? You got 10% return in both. Now you have invested in this 2,000 rupee company, you hold 5 shares and you got 10% return. 10% return on 10,000 is 1,000. And on the other hand, you have 200 shares of this 50 rupee company and you got 10% return here. 10% return on 10,000 is again 1,000. So you got 1,000 here and 1,000 here. The number of stocks doesn't matter. It doesn't matter because you get your return on the capital that you invest. You don't get your returns on the number of shares. Number of shares has nothing to do with it. You get your returns on the capital that you invest. Number of shares doesn't even come into the calculation, but people are, they're running after more number of shares because they think they have this notion that if they have more number of shares, they'll be able to grow their capital, they'll be able to get more returns. But the returns has nothing to do with the number of shares. You get your returns on the capital that you invest. Now, did this open a little window in your head, right? Are your eyes wide open? Just type EWO in the comment box. EWO is eyes wide open. People are making this mistake. They are selecting the wrong companies purely because they're looking at the share price. Because they think a smaller amount here will give them more number of shares and then make a lot of difference in their life. When it doesn't. Okay? When it doesn't. And people are making their lives more complicated because of this. Stock market is not complicated. Look at the way it has gone up. People have lost money because they are making it complicated for themselves. Stock market is so simple that even a 10-year-old can do this. And I'm not joking with you. My son is 10 years old and he has started investing. And, just the other day, his portfolio was down by 500 rupees and now it's up by 2,000 rupees. And now he's learning. He's learning the stock market can go up and down, but if you wait long enough, it will show you profit. So I've started teaching my son about this, and I've opened a Demat account under my name and given him some money, and he is using that. You can open more than one Demat account, okay? So you can open more than one Demat account, and he has started investing. And if you have younger ones, you should start teaching them as well because nobody's teaching it. We never got to learn about it. Our generation never got to learn about this. We never got to learn about money, right? I had to figure out everything on my own. Nobody taught me this. We never got to learn about it in our school and in our house. I was never made a part of the money conversation. I was a kid. What business did I have to learn about money? Or, talk elders about, hear the elders talk about money? Because I was a kid. So nobody teaches it, right? And that's quite strange, right? Because our lives revolve around money, right? It revolves around money, and we are never taught about it in our school or in our family. And we must ensure that this doesn't get passed on, and we make our younger ones, our next generation, financially literate. Nobody taught me. I had to figure out everything on my own, and I'm glad that I was able to figure out, because now I can teach my kids. My daughter is 7 years old, and the moment she turns 10, I'll start teaching her too. And she'll start investing. And by the time my kids are like 25, 26, they'll be financially independent because they would have started investing at the age of 10. And if you have younger ones, you must teach them about this, right? You must, right? Because nobody's doing it. And I'm teaching my kids in a very simple language, that kids can understand, right? I'm teaching them about business, about economy, about money, about stock market, investment, all that in a very simple language so that kids can understand, right? And since I'm teaching them, I'm also recording it, making a course out of it so that other kids can also learn, because kids deserve to learn. Nobody's teaching it, and we need to make sure that this should end with us. Our next generation should be financially literate, right? How many of you like this idea of a course for kids and kids learning early on? Just type in awesome in the comment box. Yeah, just type in awesome in the comment box, because this would really make a difference. Imagine what kind of a life an 18-year-old or a 21-year-old will live if they have this knowledge early on. By the time they're 27, 28, or maybe 30, they would be almost independent, because they know what to do with the money, how to manage it, how to invest it. We never got to learn, but we need to make sure that our next generation learns about it, right? And it's going to make a huge difference in their lives, right? Awesome. Super. So now we'll move to the secret number 3. And before we go there, I'm going to talk about that very special offer that I have for you. Okay. And in the secret number 3, you'll be learning about the strategy that one needs to have. See, right now, what people are doing is they're investing a small little amount every month, right? And this is what the crowd is doing. And if crowd is doing this, one thing is for sure that we don't want to do this, right? Because if somebody is investing a small little amount every single month, then it's going to take a long, long time for them to save something big. So what people are doing is they're investing a small little amount. So what they do is they invest a small little amount, okay? And, the goal is small little amount, right? They have a big goal. The goal is to, let's say, save 5 crores. That's their goal, right? And since they're saving a small amount, they're gonna take a long, long time. And I'll tell you how this happens. So if somebody is saving, let's say, 10,000 rupees per month, somebody is saving 10,000 rupees per month, right? And the goal is to save 5 crores, okay? Tell me, how many number of years do you think they'll take if they're saving only 5 crore, they're saving 10,000 rupees a month? How many number of years do you think they'll take to save 5 crores if they're saving and investing only 10,000 rupees a month? Give me a rough idea. How much time will it take? 25 years, somebody's typing in. Yeah, 40 years, 35 years, more than a lifetime. Somebody's saying 30 years. Yeah, of course, it's got to take a very long time, because you're saving only 10,000 rupees a month, which is like 1.2 lakh rupees. And you're talking about 500 lakhs, 500 times than what you're saving annually. It's going to take a long, long time. And even if somebody is doing a great job, it'll take 20 years at least, if not more, right? 20 years. Now, 20 years from now, in the year 2042, tell me in the comment box, how old would you be in the year 2042? Tell me, how old would you be in the year 2042? 64 years old, 55 years old, 58, 67 years old, 73 years old, 63 years old, 55, 53 years old, 55, 66 years old, 60, 49 years old, 53 years old. Yeah, tell me, how do you like this? That now you're old and you're getting the money. We'll be old and we'll get the money. 20 years from now, would you like it? Nobody would like this because we won't have much energy left. That money, maybe our kids will be able to enjoy with that money, but we won't be able to enjoy much because we'll be old. And this is the paradox of life, that when we are young, okay, so when we are young, we have what? We have the energy, not so much money, right? We have the energy, but not so much money, right? We have energy, not so much money. And when we are old, if we have done few things right in our life, we'll have money, but not the energy, right? Not the energy, right? And this is the problem, right? This is how everyone is planning their life. That they will save a small little amount, keep saving it, and in the long run, they'll be able to save something big. But this is what they're preparing themselves for, right? That when they are young, they're just saving money and hoping something good will happen. But when they are old, only then they'll get the money. Maybe the money will be enjoyed by the kids because we won't have much energy by then, right? The beauty is if you can get both money while we have the energy so that we can enjoy life as well, right? Now, how do we do this? First is, one need not have this goal as 5 crores, 10 crores, 50 crores. These arbitrary numbers, this is not how you need to plan your life, right? What you really need is, this is what you need, okay? This is what you need to plan for initially. IG. Just type in IG in the comment box and I'll tell you what IG is. IG is what you should be aiming for, not these numbers, 5 crore, 50 crore, 100 crore. IG is immediate goal. What should be your immediate goal? Your immediate goal should be the financial freedom. And financial freedom is not what people think. People think financial freedom is their ability to buy that jet plane, travel around the world, buy anything that they want. This is what people think financial freedom is. That's a misconception. The true definition of financial freedom is when you're no longer dependent on your job and you can still take care of your living standard. You can still buy the same kind of clothes, live the same life, take care of your kids, buy groceries. That is what the financial freedom is. It's not that one day you just suddenly get up and say, I want to go to Paris and go. That's not financial freedom. It is when you're no longer dependent on your job. Let's say you have expenses of 1 lakh rupees a month to take care of your family and everything. And you have an asset giving you 1 lakh rupees a month. That's when you are financially free. Because even if you stop working, you're getting that 1 lakh rupees. That is what you need. And then you're financially free. How many of you got this definition of financial freedom? Just type FF in the comment box. Yeah. FF is financial freedom. That is what I'm talking about. And that should be your immediate goal. Once you have achieved it, then you can have any number as your target. 5 crore, 500 crore, doesn't matter. But your first, you can say goal should be to achieve that financial freedom. And once you've done this, then achieve greater things. First is financial freedom. Now, how much time? How much time does it take to replace your current income? How much time does it take? How much time does it take to replace your current income, right? 20 years, 15 years, 25 years. Well, if it's taking 15, 20 years, then clearly we are doing something that the crowd is doing. Because this is what the crowd is doing. Saving a small amount, they'll take 25 years, 15, 17 years for them to save something which is substantial. And then they'll be able to, do something with it. If it's going to take 15, 20 years, then of course, we're acting like crowd. How much time should it take? We'll get the answer to this, right? And this is an important question. We need to know how much time does it take to replace your current income right now, right? So we'll get the answer to this, but let me ask you this first. How many of you are looking for a mentor in stock market and you're looking for a mentor for lifetime? Just type MM in the comment box. MM is mentor me, okay? Just type in MM in the comment box if you're looking for a mentor in stock market for lifetime. Yeah, just type MM in the comment box. Yeah. Now I've got something really special for you. Okay. And it's a special offer and a very special price. Okay. So this is what it is about. I'm going to cover this, and then I'm going to tell you how you can be a member of the 12,000 plus members that we have here. And then we'll jump to the secret number 3, which is about the strategy that we need to have, right? So yeah, now let's talk about this. Let's get an answer to this question first. Okay. Let's get an answer to this question. How much time does it take to replace the current income that you have? Okay, so I'll give you the answer straight away. Okay, it'll take 5 years for you to replace your current income if you follow this strategy that we have, right? 5 years. It'll take you 5 years. Just type in wow in the comment box. Yeah, just type in wow in the comment box. Yeah, not gonna take long, right? For some it may take 4 years. For some it may take 6-7 years. But yeah, around in about 4 to 5 years, you'll be able to replace your current income. Now, what it needs a plan. And I've got that plan for you. I will help you learn that plan through the courses and the Wednesdays mastermind. You'll be learning with me. And I'll help you in execution as well. And plus, you'll be watching me do it in the live market. That way, you'll also get practical exposure. It's not just theory. Whatever I'm telling you, I'm talking about the regular monthly income. I'm talking about hedging. I'm talking about investment. You will actually see me do that in the live market. Okay. So I will be helping you in execution as well. I will help you. Once you have learned, first is you come here and learn. And then I'll help you with the execution as well. How to execute this. Okay. And the last part is something that you and only you can do. No one else. Only you can do this, and that is sacrifice. You got to sacrifice as well, right? Now, what do I mean by sacrifice? You got to save money. There's something that you got to do. I can give you the plan. I can help you with understanding everything. I can also help you in execution as well. But the money part, saving of the money is something that you got to do, right? And how much should you save? You should at least be saving, if not more, 25% of what you earn. So if you're earning 1 lakh rupees, then you should be saving 25% of that. That means you should be saving at least 25,000. That means you can spend only 75,000. Now, let's say if you're earning 50,000 rupees, then you should be saving at least 12,500 rupees, and you should only be spending 37,500 rupees, right? Now, let's say if you're earning only 10,000, then you should be saving at least, if not more, 2,500 rupees, and you can only spend 7,500 rupees. Yeah, Rajesh, I'm going to confirm your payment. I'm going to confirm everyone's name, okay? Don't worry, I'm going to confirm everyone's name, okay? So now let's get back to that 1 lakh example, okay? So if you're earning 1 lakh or close to 1 lakh, you should be saving 25%, around 25,000. But let's say you say that I can't save 25%. I can only save 2% right now because I've got so much commitment, so many people to take care of. What do I do? Right? So it's okay. If you're not able to save much right now, it's absolutely okay. Right? But if you say that 2, 3, 4, maybe 5 years down the line, you have the same thing that you can't save much right now because there are other things that you have to cater to, then clearly you don't want to do this. And you know what is important for you is to be in an environment where we talk about the freedom, we talk about investing, we talk about saving money, growing money, wealth, all that, because your willpower is not that strong. Your environment is strong. Your environment is stronger than your willpower. Now, let's say you decide that you don't want to have sugar, but you're surrounded by people who eat sugar all day. You've got kids who eat brownie and chocolate and all these things. You've got other people in your family eating sweets all day. Guess what will happen? You'll give up because your environment is stronger than your willpower. So if you're not able to save right now, it's absolutely okay. But surround yourself in an environment where you get to, hear all this, about the financial freedom, about building wealth, about money, about saving money, about growing it, about investment opportunities, if you have surrounded yourself with that environment, guess what will happen to you? If you're not able to save right now, 2%, it's okay, right? Probably after 1 or 2 years, it'll probably be 10%. 2, 3, 4 years down the line, you'll get promotion, you'll get maybe a different job, you'll change job, you'll get more salary, and you'll be able to save more, right? So things can change. Right now, you're not able to save much. Things are not looking great for you. It's okay, but have the right kind of environment around you so that you can, find the path that can take you onto that goal that you made for yourself, the financial freedom goal, right? And the thing is that the crowd, people don't even think about financial freedom. For them, it's like too far-fetched. It's too much to even think about. People don't even take action. You're taking action by actually learning here, right? You've come here to learn. You're at least learning. You're taking that effort. People don't even make that effort to learn. You are here to learn, which is great, right? People don't talk about it. You are working. You're taking action for your financial freedom. And I'm telling you, if you apply this strategy, it will not take much time. It won't take 20 years. 4, 5, 6 years, depending on how much money you can save, how much money you have invested right now. But even if you start with scratch and you can save that 20-25%, in about 5 years, you can achieve this financial freedom, right? And I'll talk about the strategy as well, right? Talk about the strategy. But right now, let's say you're not able to save much. You can't, your salary is less. All that is okay. You join the Freedom Investors Hub, be in the right kind of environment, and this will help you grow. Right. Let's talk about the strategy here. Yeah. So Junaid, I'm going to confirm everyone's name. Anushri, Harshit, Divya. I'm going to take each and everyone's name. So I'm not taking everyone's name because I want to concentrate here and talk about the strategy part. Okay. So let's talk about the strategy part. If I haven't taken your name, just relax. I'm going to take your name later on. Okay. Super. Only thing is you made the payment. You've become a lifetime member. That's what you should remember, okay? And those, who want to get in, this is the link. The only thing is that this is live. The link and the offer is live till the time the webinar is live. After this, the price will jump back to 1 lakh rupees. So 8995, including the GST right now for some time, okay? Super. So what kind of a strategy are we looking at, right? So what is that key to success in stock market? So let's talk about that. So how people look at, the stock market is, so there are two kinds of crowd here, okay? So there are two kinds of crowd here, and this is the first kind. So there are people who think that they need to invest, okay? And they'll only invest. What they do is they save a small amount every month, okay? What they're doing, they're saving a small amount every month, and what they're thinking is that by just investing, they'll be able to make a lot of money by just investing, right? What they're thinking is that I'll invest this small amount every month, but it's gonna take a long time. If somebody is investing this small little amount, it's gonna take a long time. Okay. Another problem is that there is no cash flow, because what you've done is you have invested your money, okay, and you're looking at the money going up and down, the portfolio value going up and down, and there's no cash coming towards you. Maybe a little bit of dividend, which is almost negligible, small amount of dividend coming your way, but no real cash flow coming your way because the portfolio is invested for long term and that's all it's doing, right? And you can't hedge. When you're investing and you know only about the cash market, so people are investing now. Where are they investing? They're investing in the cash market, right? What is the cash market? Or you can call it the equity market, right? What is cash market or the equity market? They're the same thing, okay? They're one and the same thing. So cash market or the equity market is where you buy shares from, right? You buy the Tata Motors, you buy the, just a second. Yeah, you buy the, Reliance share, all that, right? Yeah, here's the link for you, okay? Yeah. So people are investing, okay? And the problem is that they have built a portfolio, and since they are just knowing about the cash market or the equity market, they can't hedge, because in equity market you can only invest and hope the price goes up. If it goes down, there is nothing that you can do to protect your portfolio. You can't hedge here. You can't protect. your portfolio, right? You can't protect your portfolio. So that's the problem, right? If you can't protect your portfolio, you're just on market's mercy here, okay? So that's the crowd number one, who think that all you need to do here is to invest, but it's going to take a long, long time. And we have mentioned few things here, some of the shortcomings here, right? Now there's another kind of crowd here, and this kind of crowd think that they just need to trade. They don't need to invest, right? They'll trade in the future and options market, right? They're thinking they'll trade in future and options market, and they can convert that 2, 3, 4 lakh rupees into 5 lakh, 8 lakh, 10 lakh, and that's how they can keep growing their money. All they need is they just need to trade. They'll do the trading. Who needs to invest? They think they don't need to invest. They'll just do the trading only. And people who think that they don't need to invest, they'll trade with whatever money that they have, they are going to lose it all. If they don't stop, they are going to lose it all, everything, because future and option market trading is risky. Yeah. Neha, here's the link for you. Yeah. Here's the link. Click on it and you can get in. Okay. This is risky. If you're just trading and you think there's no need to invest, then you are going to lose it all. If you don't stop, you are going to lose it all. Okay. So there is this kind who think that only trading is required, right? But the key to success here is to combine, to blend the two different markets, the cash market and the future and option market. When you blend the two different markets, magic happens. The risk goes down and the profitability goes up. I'll tell you how, right? So when you do this, okay, so when you combine the future and option market and the cash market, right? When you combine the future and option market and the cash market, what happens is the risk goes down. How does the risk go down? When you combine the two different markets, how is the risk going down? When you're combining it, whatever shortcomings are there for this market will be taken care of by this market, the future and option market. And whatever future and option market, whatever the risk is there, whatever the shortcomings are there, will be taken care of by the cash market, the equity market, right? Yeah. Senthil Kumar, here's the link for you. Okay. Yeah. So I'll tell you now, let's discuss the shortcomings. So the cash market, what kind of shortcomings it has? What kind of, the negatives for the cash market? One is that, you're investing a small amount because, at the end of the month, there's only so much money we can save. There are other expenses as well. And whatever small investment that we do, well, we are expected to wait on for a long, long time, right? So if you invest only a small amount, that is taken care of. How? Because here in Freedom Investors Hub, as I said, we generate a regular monthly income, okay? And this regular monthly income, we invest it back. So you're not just investing money from your own pocket, you are also making money and you're putting it in the market. So you put more money in, not just a small little amount from your own pocket, you also earn money from the market and put it back, right? And it's not going to take a long, long time because you're not just saving money from your own pocket, you're also earning money from the market, putting it back. And since you're able to save more money, it's not going to take a long, long time. And there is a regular cash flow towards you, right? Because this cash flow that we're making, the regular monthly, you're investing it back, but the cash flow is there. You're getting this cash flow. Now, why are you investing it back, right? Because you have learned this, the power of delayed gratification, that if you don't consume today, you'll have much more in the future. So although you're making that regular monthly income, you're putting it back into the portfolio because you want to grow the portfolio and you want to grow it faster. You know that I can choose to not, enjoy with this money right now because in the future, I'm going to have much more, right? So you're willing to make that sacrifice, the power of delayed gratification, right? So this no cash flow problem will also be taken care of. You are able to generate that regular income. And since you are clubbing the future and option market along with the cash market, you'll be able to hedge the portfolio because that hedging comes from the portfolio from the future and option only. Okay. So the hedging comes from the future and option, and we are combining it with the cash market, the future and option. So we are able to hedge the portfolio as well. right? Now let's talk about the future and option market. Now, what is the problem here? The problem here is it's risky. You can lose it all. You can lose a lot of money here if you're doing it in future and option market, but we're combining it with the cash market, because that's why, if you look at this, what have I written here? You will be able to generate this regular monthly income without taking any additional risk. So even if you're retired or you're very close to getting retired, it will make sense for you to get in, because you will learn how to, do this with your money that you have, the big amount of money that you have for your retirement. How can you, get this additional income? Okay, so we are able to, have this zero risk. Whatever investment risk is there, that's the only risk that we have, right? So we are able to do this because we are combining it with the investments. That's why this risk is also taken care of, right? This risk is also taken care of. So what we're doing is we are clubbing the two different markets. And because we are clubbing the two different markets, we are able to get lower risk and the profitability goes up. And always strive to reduce the risk. Yeah, even if you're, in a full-time job, you can still do it, right? It won't require much time, right? And you'll be able to generate the income. It doesn't require you to sit in front of the computer, right? So when we are combining the two different markets, we get the maximum benefit and the risk actually goes down. And whenever you're investing or trading, you should strive to lower down the risk. We never want to increase risk. We hate risk. We don't want risk. We want to reduce it. Even when we are trading, we want lesser risk. Okay. Now, what happens is, so when people are investing, they're building a portfolio. This is what they're doing, right? This is what they're doing. They are just investing their own money. They're accumulating. That's all they know. They're investing every month a small little amount. And we know that, if somebody's just doing this, it's going to take a long, long time. And we'll take an example here. We'll take a quick example here. Now, let's say if somebody is saving around 8 to 10,000 rupees per month, okay? If somebody is saving 8 to 10,000 rupees per month, then what they're doing is, okay, so if somebody is, doing this, if somebody's saving 10,000 rupees a month, and they have a small little portfolio of around 7-8 lakh rupees, let's say, they have a portfolio of 7-8 lakh rupees, right? And if just they're doing this, they're saving every month and keep accumulating, then they're acting like crowd. And it's going to take them a long, long time, 20, 25 years, 15 years. And we know that, if we save for 15, 20, 25 years, it's going to take a long, long time. And we don't want to do that, right? We don't want to be old and then getting the money, right? So this is not the only thing that we do. We also put our money, but this is not the only thing that we do. What we also do is, we also apply two strategies here, which is working like charm. And that is making all the difference here, okay? One of the strategies is earning from the portfolio. So we generate that regular monthly income and we put this money back into the portfolio. So what we do here is, okay, we also generate regular monthly income, okay, on the portfolio that we have, okay? And we are not taking any additional risk in order to generate income, okay? Yeah, Neha, I'm going to confirm your name as well. Don't worry about it, okay? So what we would do is we'll also generate the regular income at no additional risk and we put it back into the portfolio, right? So on the portfolio, we'll be able to generate the regular income. Now, let's say we are able to generate a regular income of, let's say, around 10,000 rupees per month. So this money goes back into the portfolio, okay? This money goes back into the portfolio. So we are now not just saving 10,000 rupees from here, we're also generating 10,000 rupees per month from this regular monthly income. And we are now saving twice the amount, okay? We are saving twice the amount, right? Which is great, right? We're able to save twice the amount. That means we'll be able to save more and it won't take much time as well. And it doesn't end there, right? It doesn't end there. In this Freedom Investor journey, we would also be learning how do you go about, how do you go about trading? There are courses for it. You'll learn about them later, right? You can upgrade. There are courses on trading as well. And again, as I said, we want to reduce the risk as much as we can, even in trading. And whatever trading returns that we make, we put that money back into the portfolio, right? So whatever trading return that we make, TI, the trading return, this trading return, and I'll just write it as trading income, okay? Whatever trading income that we make goes back into the portfolio, right? And you don't need additional money to generate this, right? You don't need more money. You don't need cash to do this, okay? I'll tell you how to go about it. So this trading income that we make, let's say if we are able to make another 8,000-10,000 rupees per month, okay? This money again goes back into the portfolio, right? If you made the payment, superb. I'm going to confirm everyone's name, okay? Yeah. And yeah, here is the link for you, okay? Yeah, okay. Let me just copy the link here. Just give me a second. Yeah, okay. So yeah, so it is 8,995, and on that portfolio alone, you'll be able to make that 8,000-10,000 rupees, and I'm talking about per month, right? On an average. So you'll be making a lot of money here, right? So 8 to 10,000 rupees from trading as well. And what happens to this is this money also goes back into the portfolio, right? So you'll see the money is flowing from all different directions, and we're not just saving 8-10,000 rupees from our own pocket. We're also putting in 8-10,000 rupees by earning the regular monthly income, another 8-10,000 rupees from this trading income. That means we are able to save thrice as much, okay? We are able to save thrice as much, okay? Yeah, we're able to save thrice as much. So whatever, time it would have taken us to save 15 years, right? Whatever amount that we would have saved in 15 years, we would be able to save that in 5 years because we are saving 3 times, okay? 3 times. And all this you'll learn, okay? All this you'll be learning, yeah? Yeah? So yeah, earning 8-10,000 rupees. Yes, of course. This is what we do here in Freedom Investors Hub. That's what you'll be learning here, right? And since this money is going back into the portfolio, and this is not the only thing that we're doing, everyone else is just doing this, okay? Everyone else is just doing this. We are learning, as I said, we are learning. If you're just investing 15-16%, anyone can get by just investing in Nifty ETF. But we are learning, we want slightly more returns, right? And by applying these strategies, we are able to save more money. And since money is going from all different directions, the portfolio value will start to grow, and it'll grow faster, and it'll reach such a stage that we'll all be able to achieve the freedom that we all aspire, right? And it doesn't matter bull market, bear market. Stock market, Indian economy has been doing well and will continue to do well. In the last 25 years, we have seen a lot of things, and the stock market has grown, economy has grown. The last 25 years, we have seen a war. We had war with Pakistan, Kargil war. We had sanctions because of the nuclear test that we did. Then we had that dot-com bust. In 2008, we had that financial crisis. We had that pandemic recently. We had a war going on right now. We have a war which is between Russia and Ukraine. We have seen, the European debt crisis, US debt ceiling crisis, a lot of things that we have seen, and yet the market has grown. Yet the economy has grown. Even in the future, the economy will continue to grow, and probably will grow faster. If you look at history, the bulk of money is made by people who are in that $2 to $5 trillion. So we have recently crossed 2 trillion. We are on our way to be 5 trillion. Maximum amount of wealth is made when you are between that period of $2 to $5 trillion. We are in that period. So India will grow, economy will grow. Question is, are you growing? India grew in the last 10, 15, 20 years. Did you grow? India will grow even in the future. The question is, are you willing to grow? It'll be real tragedy if India grows, everyone grows, and we are left behind. It'll be a real tragedy, right? And you can start with any amount. Just be consistent. Invest first. Okay, build a portfolio. Even if you're investing 5, 10, 15,000, it's okay. Keep investing. Build a portfolio and then learn all this and start implementing it. If you're not able to do all the things that we do here, it's okay. Save money, as I said. You have lifetime access. Learn, save money, and then start doing it. You will see me do it, implement it, and then you come here, learn. You kind of observe how I do things, and then you implement. Implementation comes at the end. Okay. So this is how we do it here. And again, as I said, the question is, everyone is growing. India is growing. Are you growing? That's the question that you gotta ask yourself, right? And some of the trainings that I've taken, this one is at NSC's office, National Stock Exchange office in Delhi. And this one is for ICICI HNI client, high net worth individual clients of ICICI. And that's me in the background. If you're looking for me, that is me in the background.